Most people think wealth is built by chasing returns. The truth is, real wealth is built by preparing for what breaks next. When uncertainty rises, smart money doesn't ask, "What's trending?" It asks, "What will the world desperately need when today's systems fail?" Inflation is unstable, supply chains are fragile, resources are political, and the future is arriving faster than governments can plan for it. So here's the question most people never ask. Why would some of the richest Americans quietly move capital toward one of the coldest, emptiest places on earth? If you understand that answer, you understand how power, money, and the future really work. Capital moves toward scarcity before the crowd feels it. Most people believe money follows opportunity. In reality, smart capital follows scarcity, quietly, early, and often invisibly. Scarcity is not created overnight. It forms slowly beneath the surface, while the majority of people are distracted by short-term noise, stock prices, headlines, political drama, and quarterly earnings. By the time scarcity becomes obvious to the public, it is no longer an opportunity. It is a crisis. Experienced investors understand a simple principle. When something becomes scarce, it becomes powerful. And when something becomes powerful, capital wants to control it before demand explodes. This is why large, patient capital never waits for confirmation. It moves during uncertainty, not clarity. When the future feels uncomfortable, confusing, or distant, that is precisely when long-term money starts positioning itself. Scarcity can take many forms. It can be physical, like land, minerals, water, or energy. It can be strategic, such as trade routes, geographic positioning, or political leverage. Or it can be structural, access to stable systems when others are fragile. The key insight is this: scarcity is predictable long before it is visible. Climate pressure, population growth, geopolitical tension, and technological demand are not sudden events. They are slow, compounding forces. Investors who think in decades watch these forces quietly reshape the world. They don't wait for shortages to appear. They ask where shortages must eventually exist. This is where the crowd fails. Most people invest emotionally. They need proof, they need popularity, they need reassurance from others. As a result, they arrive late, when prices are already high and risk is already concentrated. Smart capital behaves differently. It accepts temporary uncertainty in exchange for long-term control. It is willing to look early, wrong, or boring because it understands that being early feels uncomfortable, but being late is expensive. When capital moves towards scarcity early, it gains three advantages. First, pricing power. Assets tied to future scarcity are cheap before demand arrives. Second, strategic positioning. Early ownership shapes future influence. Third, optionality. The investor doesn't need a single outcome, only that scarcity increases. This is why regions, resources, and systems that seem irrelevant today often become critical tomorrow, not because of speculation, but because economic reality eventually forces attention. The crowd reacts to headlines. Smart capital prepares for inevitabilities. In every major economic shift, energy transitions, resource shortages, geopolitical realignments, the pattern is the same. Those who moved early didn't have better information. They had better time horizons. And that is the lesson behind this principle. By the time scarcity feels urgent, ownership has already changed hands. In stable times, geography feels irrelevant. Digital money moves instantly. Supply chains stretch across continents. Borders appear less important than screens and systems. But history teaches a hard lesson. When systems weaken, geography reasserts its power. Financial systems, currencies, and political agreements are built on trust. When that trust erodes through debt, conflict, inflation, or environmental stress, physical reality takes over. At that point, location matters more than ideology, and land matters more than promises. Geography is permanent, systems are not. When trade flows smoothly, no one notices choke points. When energy is cheap, no one cares where it comes from. When food is abundant, land feels ordinary. But under pressure, the world doesn't run on theories. It runs on access. Access to resources, access to roots, access to stability. This is why, during periods of global stress, power shifts away from abstract financial instruments and toward tangible positioning. Ports matter. Shipping lanes matter. Proximity to raw materials matters. Control over land becomes leverage. Smart capital understands this deeply. Large, long-term investors do not see geography as a map. They see it as a balance sheet. They ask questions most people ignore. Which locations reduce dependency? Which regions gain relevance as trade routes shift? Which places remain functional when others face disruption? When systems weaken, globalization slows. Countries prioritize security over efficiency. Supply chains shorten. Governments intervene. At that moment, geography determines who adapts smoothly and who struggles. This is not theory, it is economic gravity. History shows that every time the global order is stressed, physical positioning becomes more valuable than financial engineering. During wars, depressions, energy shocks, and trade conflicts, nations and investors with strategic geography gain influence without needing to act aggressively. Their value increases simply because others need access. The crowd often misunderstands this. They assume modern technology has eliminated geography. In reality, technology amplifies it. The more complex the system, the more vulnerable it becomes to physical disruption. A single route blocked, a single region destabilized, a single resource restricted. Suddenly, location decides outcomes. This is why patient capital looks at places others dismiss as remote, cold, or undeveloped, not because they are profitable today, but because their relevance rises as systems strain. Geography doesn't need growth to become valuable. It only needs pressure elsewhere. When investors position capital in strategic locations, they are not predicting collapse. They are preparing for friction, a world where efficiency declines and resilience becomes priceless. The deeper truth is simple. Financial systems promise returns. Geography provides security. And in uncertain eras, security becomes the most valuable currency of all. That is why geography quietly turns into power. Not when everything works, but when it no longer does. Most people treat climate change as an argument. Investors treat it as a cost structure. Markets don't care about opinions, they care about risk, probability, and exposure. Whether one believes in climate narratives or not is irrelevant to capital. What matters is how climate forces change inputs, disrupt outputs, and reprice assets over time. From an economic perspective, climate change is not emotional, it is mathematical. Rising temperatures affect productivity. Extreme weather increases insurance losses. Shifting seasons disrupt agriculture. Melting ice opens routes and exposes resources. Each of these changes alters cash flows, costs, and long-term asset values. That is why serious capital doesn't argue about climate. It accounts for it. Every investor, knowingly or not, is exposed to climate risk. The only question is whether that risk is priced correctly. When risk is mispriced, opportunity exists. Smart capital studies second-order effects. It doesn't focus on disasters. It focuses on reallocation. As some regions become less reliable, others become more valuable. As certain resources become unstable, alternatives gain importance. As old infrastructure struggles, new positioning becomes strategic. This is how climate pressure reshapes balance sheets. Ports in vulnerable zones face rising maintenance costs. Insurance premiums rise or disappear. Food-producing land changes value. Energy systems are forced to adapt. None of this requires belief, only observation. The crowd reacts emotionally to climate news. Markets react slowly, unevenly, and often late. That delay creates a window where capital can reposition before prices reflect reality. Long-term investors think in probabilities, not certainties. They ask, where does risk concentrate over the next 20 years? Which assets benefit from adaptation rather than resistance? Which locations gain importance as conditions shift? This is why climate pressure quietly redirects money toward resilience, cooler regions, resource rich land, stable water access, and adaptable infrastructure. These assets are not exciting in boom times, but they become invaluable under stress. Importantly, smart capital does not assume catastrophe, it assumes change, and change in economics always redistributes value. Ignoring climate risk is not neutral, it is a position. And historically, unpriced risk eventually appears on the balance sheet, often suddenly and violently. The deeper principle is this: markets punish denial, not debate. Investors who understand climate as an economic variable, not a moral one, gain clarity. They don't chase narratives, they quietly adjust exposure, reduce fragility, and increase optionality. Because in the long run, nature does not negotiate with financial models, it simply sends the invoice. And capital, as always, moves to whoever is prepared to pay or positioned to profit when that invoice arrives. Most investors react to what is loud. Long-term investors prepare for what is possible. Headlines create urgency. They compress time, trigger emotion, and demand immediate action. Optionality does the opposite. It expands time. It creates flexibility. It allows investors to benefit from multiple futures without needing to predict exactly which one will occur. This difference defines the gap between speculation and strategy. Headlines force a single narrative: growth or crash, boom or bust, win or lose. Optionality accepts uncertainty as a permanent condition. Instead of asking, what will happen, it asks, what could happen, and how do I stay advantaged either way? This is how serious capital survives across decades. Optionality means owning assets that gain value under several scenarios. If one outcome fails, another still works. The investor does not need perfect foresight, only exposure to asymmetric outcomes, where upside exceeds downside. Short-term investors chase confirmation. They need clarity before acting, but clarity arrives late when prices already reflect it. Long-term investors accept ambiguity early, when assets are undervalued precisely because outcomes are unclear. That discomfort is the price of optionality. Consider how markets price certainty. When something is obvious, competition is intense, valuations are high, and risk is hidden. When something is uncertain, capital withdraws, prices fall, and opportunity quietly forms. Optionality lives in that space. It does not rely on timing markets or predicting events. It relies on positioning capital where change increases value. The investor is not betting on a headline, they are owning a choice. This is why patient capital often looks inactive. It does not trade frequently, it does not explain itself publicly, it waits while others react. Optionality also protects against error. When investors tie their success to a single narrative, they become fragile. When reality deviates, losses compound. Optionality absorbs mistakes. It allows adaptation without forced selling. In an era of rapid change, technological shifts, climate pressure, geopolitical tension, certainty is expensive and short-lived. Flexibility, on the other hand, compounds. The crowd confuses action with intelligence. Long-term investors understand that positioning beats prediction. They would rather be early and uncertain than late and confirmed. They accept low short-term returns in exchange for high long-term resilience. Their goal is not excitement, it is endurance. The deeper lesson is simple. Headlines expire quickly. Optionality does not. Those who invest in narratives are constantly adjusting. Those who invest in optionality remain prepared. And in a world where the future keeps changing shape, the ability to adapt becomes more valuable than the ability to predict. That is why long-term investors buy optionality and let the headlines pass by. Crowded trades feel safe, they are familiar, popular, and constantly discussed. But in finance, popularity is rarely protection. It is often risk disguised as comfort. When too many investors pursue the same opportunity, the trade stops being about value and becomes about timing. At that point, returns depend not on fundamentals, but on finding someone else willing to pay more. That is not investing. That is positioning inside a crowd. Real wealth behaves differently. Long-term capital understands that the greatest risk is not volatility, it is consensus. When everyone agrees, prices already reflect optimism. Upside becomes limited while downside grows quietly. Crowded trades share common features. They dominate headlines. They are easy to explain. They offer recent success stories. And because of that, they attract emotional capital. Money driven by fear of missing out rather than long-term logic. Smart capital avoids these environments, not because they are guaranteed to fail, but because the risk to reward balance deteriorates. When everyone is on the same side, there is no margin of safety. History repeats this pattern relentlessly. Technology booms, housing manias, commodity supercycles, speculative assets. Each begins quietly, becomes crowded, and eventually collapses under its own expectations. The collapse is not caused by bad assets, but by too many people believing the same story at the same time. Real wealth is built where patience is required. Uncrowded opportunities are uncomfortable. They lack validation. They often look boring, slow, or outdated. That discomfort keeps most people away, and that absence keeps prices reasonable. This is where long-term capital thrives. Avoiding crowded trades does not mean avoiding growth. It means avoiding overconfidence. It means understanding that returns come from buying assets when they are ignored, not celebrated. Smart investors ask different questions. Who is not here yet? Why is this unpopular? What would need to change for this to matter? These questions lead capital away from noise and toward structure. Crowded trades also create fragility. When sentiment shifts, exits become narrow. Liquidity disappears precisely when it is needed most. Long-term investors avoid this trap by entering positions where they are not forced to compete for the same exit. The crowd believes safety comes from numbers. Smart capital knows safety comes from distance, distance from emotion, distance from narratives, distance from urgency. The deeper truth is this: if an opportunity requires constant excitement to justify its price, it is already expensive. Real wealth compounds quietly away from applause. It grows in places that do not need constant explanation, because in the end, markets reward those who are willing to stand alone early and punish those who stand together too late. That is why real wealth avoids crowded trades. In stable times, investors chase returns. In uncertain times, they seek control. Return is a number, control is a position. When systems are predictable, return optimization makes sense. Risks are measurable, correlations hold, and liquidity is assumed. But when uncertainty rises through inflation, geopolitical tension, supply disruptions, or structural change, returns become fragile. They depend on assumptions that may no longer hold. Control, on the other hand, reduces dependency. Control means owning assets that do not require constant cooperation from others to function. It means having influence over inputs, access, and timing. It does not eliminate risk, but it shifts power toward the holder. This is why serious capital changes behavior during uncertain eras. Instead of maximizing yield, it prioritizes assets that preserve autonomy, land, resources, infrastructure, logistics, and strategic positioning. These assets may not offer the highest short-term returns, but they offer something more valuable: resilience. When uncertainty increases, leverage loses appeal. Financial engineering becomes fragile. Promised returns rely on smooth conditions. The more complex the structure, the more points of failure it contains. Control simplifies. Owning something essential, rather than a claim on someone else's promise, changes the risk profile entirely. It reduces exposure to policy shifts, counterparty failure, and systemic breakdown. This is not about domination. It is about option preservation. Control allows investors to wait, to adapt, to negotiate from strength rather than urgency. Return-focused strategies often require precise timing. They work until they don't. Control-based strategies endure because they remain valuable across multiple outcomes. The crowd misunderstands this trade-off. They see lower immediate returns and assume inefficiency. Long-term capital sees insurance. History consistently confirms this behavior. During periods of stress, those who control essential assets gain pricing power without chasing it. They do not need to sell at the wrong time. Others come to them. Control also changes psychology. Investors with control do not panic. They are not forced into reactive decisions. They can think clearly while others rush for liquidity. The deeper principle is simple. When the future is unclear, flexibility beats precision. Returns depend on forecasts. Control survives forecast errors. That is why, in uncertain eras, capital willingly accepts lower yields in exchange for higher certainty of survival. Because wealth is not measured by peak performance in perfect conditions, but by persistence through imperfect ones. In the end, the strongest portfolios are not those that grow the fastest, but those that cannot be easily broken. And that is why, when uncertainty rises, control quietly beats return. Most people invest for speed. The wealthy invest for survival. They don't ask, how much can I make? They ask, where will value still exist when the world changes? Because in every economic cycle, the future rewards those who prepared, not those who reacted.